the next session is on primer on valuation standards, which will be taken by CA K Kuashik Raj. I request our chairman to escort the speaker to the dais and also greet him. Welcome to you, Kaushik. Thank you for consenting. Thank you. Please take this. Kaushik is a fellow member of the Institute, a being registered valuer for asset class SFA and has graduated from the St. Joseph College of Commerce. He qualified in the year 2014. He was associated with Big Four for a stint of 2 years and then moved on to start his own practice. His passion lies in direct taxes, and he takes classes for the students of company secretary and chartered accountants students. He is currently partner in Kaushik and Shivram Chartered Accountants and leading the direct practice, the tax practice of the firm. He is active speaker in many forums and specializes in business valuations, direct taxes, startup consultancy, and so on. Kaushik, it's a pleasure to have you and a pleasure to present Kaushik Raj to all of you. Over to you, Kaushik.
Very happy afternoon. After a sumptuous meal, I think all of you are ready to go to the deep sleep. Yes, assertively and positively I can hear certain yes from the audience, so it's a difficult job for me to ensure that you don't go into sleep, isn't it? Okay, so let me try my best to ensure that I keep you alert and make the session attractive for you to get some insights on the valuation standards. So I have the title or the topic given to me as the primer on valuation standards. So when we see primer means or primer on valuation standard, to get the overview of the standards that governing the valuation at the outset or the entire process of valuation, as to how the entire mechanism of conducting evaluation or an assessment of a valuation assignment or an valuation principles has to be adopted. So let's look into that. That is the main overview of the topic first, and then let's get into valuation standards. So like when we hear the word standards, is this for the first time are we hearing the standards associated with the word valuation? Definitely not. It is, we have seen there are different standards. You would have heard of accounting standards, auditing standards, internal audit standards, company secretarial standards. So definitely we all will have certain idea as to say what does the standard convey in those respective segments, isn't it? Can somebody give some insights or share your thoughts as to what does standard mean to you in terms of these aspects? Guidelines? Yes?
Baseline level of expectation.
Yes, that's a very fundamental thing. Is minimum expectation is that you comply at least so much, and then over and above that there could be more aspects to it that which can have the professional skepticism of judgment or assessment and assertions, all of that. Any other points?
Uniformity in the judgments used.
Correct. Uniformity, or so there is a common platform that everybody follow and comply. Yes. Any other points? Okay. I think pretty much the more or less the major points have been covered. Let's jump into it and see. I have divided my session into an introduction as to see why valuation standards, what is the background, what is the framework, all of that. And also then we move on to the valuation standards as such, how it got evolved and what was the reason for it as a mechanism of the standards being implemented in India and the international scenario in comparison with the international scenario. Is how is that in comparison to the Indian framework? So we see that comparison and also see the differentiators, and we see what are the carve-outs from the international standards as well. And then we move on to the question and answer session and see if there's anything that I could help you to understand in more detail. So first and foremost, like I said, the vision of why there is a requirement for valuation standards. So when we see that, we get to know that most of you have already said that, some of you have already said that it is a procedure or it is a principle or is it a concept. So it should have certain framework which is generally accepted across the area or all the professionals or in the industry as such. So when we see in this kind of thing, what do we understand by the word procedures? Like in terms or in context of valuation. So there are, in terms of procedures, we would have already seen in the first 3 sessions in the morning, there are a lot of words that you would have already seen in terms of the methodologies or the approach, or in terms of the methods that needs to be done, in terms of the purchase price allocation and all the other aspects. So those are the procedures as to be commonly set up in terms of the uniformity of the sale, and also in terms of the principles, certain principles as a conceptual principles as to how you will have to interpret a certain standard, or how you will have to approach a certain scenario when there is ambiguity or when there is any confusion as to how do you approach. Like in the first session today, my fellow speaker Anjan was telling that we have only scratched the surface of the glacier. There are a lot of things. So there is definitely, when we go in depth in the real life scenarios, there are a lot of situations where we have roadblocks. How do we resolve these roadblocks? So what are the principles to be adopted is what these valuation standards to a certain level give us the framework. So when we hear out the word valuation, what is valuation? When we see valuation, you would have heard that valuation is a science or an art. There's a lot of literature that goes around the buzzword called whether is it an art or is it a science. Okay, so what is when we see that it is definitely completely not science and definitely not completely art. So it is a mixture of both art and science. So when we say that, so it is that mean to say that is it completely going in terms of some prescribed format, that then entirely how to calculate, how to apply the valuation principles, everything is given in the valuation standards? Then is it completely mandating us to be on a science side? What do you feel? So if everything is standardized, if everything is put into a prescribed mode, telling that these are the step 1, step 2, step 3, and these are the things to be included, these are the things to be excluded, this is what you'll have to consider, and this is what you'll have to perform as a evaluation mechanism. So will it, how does it mean to be on an art side, and is it completely going on the side of science? If it is regulated in such manner, it definitely lead to completely a science mechanism, right? So let's take an example. In the just before the lunch session, we had the speaker who is talking about the regulatory framework. In terms of income tax valuation, when we say Rule 11UA valuation, it is a prescribed format. So you have certain aspects to be added, certain aspects to be subtracted, and then you arrive at the value, and there is no art in it. It is a science. Correct? So are the valuation standards intending to impose such kind of mechanism into the valuation professionals by doing the standards? What could you think of? Any thoughts? So is the intention of valuation standards to make it completely a manner of fixed format kind of assignment or evaluation?
No.
No. Then what does the, like when we see the vision, then what does it convey? So
It's a combination of science and analysis. There are set procedures, also you have to apply your mind beyond those set procedures.
okay, so it is a combination. So, but are we, now the question here is, are we going into a set procedures completely and restricting ourselves to procedure? And is there a scope for us to go beyond the procedure and have that kind of judgmental evaluations? So when the answer that I could put across here is that the valuation standards is a preliminary based framework. Like one of our friend here said that it is the minimum expectation. So valuation standards try to set the minimum baseline compliance in terms of commonizing the approach by the professionals in the industry across. So, but over and above is that element of art which comes into the picture in terms of how complex situations can be taken into picture. When we go in further, when we go into the standard prescribes the approaches. So there is a little bit of easy position for me, because that most of the terminologies is that already you have seen in the last 3 sessions, like asset approach or the market approach or the income approach. So you would have seen certain kinds of words, all of that. So that is all coming from the valuation standards. So when we go there, we get to know that there are certain approaches mentioned. But In the first session that we discussed about a specific approach of valuation in terms of the option pricing model or the OPM model. So if you check whether OPM model is prescribed in the valuation standard, it is not there. Okay, valuation standard says you'll have to follow the minimum thing, but OPM is a derived approach from the income approach at the broader level, which is a DCF value, and then an option pricing model, which is a Black-Scholes model. It is a convergence of that. So here the art is getting involved in terms of deriving a new model based on lot of research and lot of studies that have been conducted over a period of time across the globe. It's not that what is happening in India, but as a practice, there are a lot of valuation professionals, valuation research organizations where they have performed a lot of iterations in order to derive this kind of new-aged or different models apart from what is prescribed in the valuation standards. So when we say valuation standards, it is the base minimum expectation. So when we go out in the market, we cannot tell what is given in valuation standards: income approach, asset approach, market approach. I will do my valuation only in these three approach. If you want, you can get the valuation done from me, otherwise I will not do, because valuation standard is telling me to do only these three approach. I cannot be in such strict compliant manner to say that I will restrict my work advisory in terms of only these three approaches. But I have to be open up to see what more I can do. That is the art element which is coming into the valuation as a process as a whole. So there it is a combination of both science and art which gets into this as a process. So this vision is that to promote the best practice in India, the Institute of Chartered Accountant of India has issued the valuation standards. So we'll get into that a little more later also, but the vision of the Indian valuation standards was to set up the procedures, principles and concepts which are accepted internationally. When we compare these valuation standards for the international valuation standards, we'll move into in subsequent slides, we'll also see the background of how the international valuation standards are evolved and what are the different international standards that are prevailing in the context of valuation profession. So when we see that, they have more or less made it similar to what it can be accepted internationally. It is an Indianized version, but in order to ensure that it is globally accepted or internationally accepted across the regions and countries. So like how we have Ind AS, which is a carve-out from IFRS, which is an Indianized version. Similarly, the Indian valuation standards are there from the, which is globally suitable to be accepted. But as of now, Indian valuation standards are not notified by the international organization as an international valuation standard, but it is more than eligible to become a international valuation standard. So let's see what is the achievement of valuation standards. So uniformity. So when I say uniformity, that let's take now that you are all familiar with the approaches, I now and then keep using these approaches. So let's say that uniformity, like same assignment of a valuation of a subject company or a company X is done by valuer A and valuer B. If valuer A is adopting a DCF method or an income approach method and valuer B is adopting a market method or a market approach, so there is no uniformity as to how they have applied in terms of the two different approaches. Or in case of a statutory regulatory framework, when it comes to SEBI, they say you apply all the three methods. Like the previous speaker was telling that it is imposed to be done in all the three approaches and you give the weightage for each of the methods where the value is getting arrived. So when we do this, so where is the uniformity? So there is no uniformity, so the valuation standards will achieve this in order to get the uniformity as to in which scenario you are going to use the market approach. This is a broad guideline. That does not mean it is restricted to use only that approach, it is a broad guideline. Similarly, where you will have to use the income approach. So in the scenarios, in the possible scenarios, how a valuation can be done of a subject company in terms of the approach that can be used. So that is where you can see the uniformity. And in terms of the quality, so when we say quality, we'll have to look at the various aspects that are being mentioned in the valuation standards in order to enhance the quality of the work. So when we see a way back, so this valuation standards evolved in 2018. We'll see that the dates will come in the subsequent slides. But before that, it broadly had nothing to do in India as to Indianized version of any standards. It was only, we'll have to rely on the international, any literature or any standard or there are different resources where which we can take the references. So when we see at that point in time, there was no guiding force in India for the professionals who are performing the valuation in any given point in time. So the quality was very less. If you go back and see in some 10 years back any valuation report, some valuation reports are as good as 2-pager report or a 3-pager report. They might have done the humongous amount of effort in terms of deriving the valuation, but the valuation report consisted, so this is the value, this is the purpose it is being done, and this is the end value or the enterprise value. But as a reader, of a valuation report, he would like to understand what is the background and how is this value being derived, what was the basis, what approach was being used, what are the assumptions being made. So when we go into deriving the value, there is a lot of assumptions in terms of the valuation process. So when we go for discounting rate will be the valuation thing, and the tax rate considered, and the growth rate that is being considered. So there are a lot of factors which will need to be understood as a reader of the report. If these are not given in the report, then how do we understand what is being performed by the valuer? So in order to enhance this quality, valuation standards have made certain reporting formats and documentation guidelines, indicative, illustrative things which should form part of the report. Thereby the quality of the reports are being now enhanced. Transparency, the process of transparency. So in terms of the quality, as far as the quality is being enhanced, the transparency of the approach being used, because it is all forming part of the report now. So when we see the report, we know this is the subject company, this is the class of share being valued, this is the capital structure, and this is the valuer approach that is being used, and why not the other approach being used is also documented in the valuation reports, which makes the reader to read and understand the report in a better manner and assess the investment decision in a better logic. Also in terms of when we see the international things, in terms of the international transactions or cross-border transactions, if somebody has to invest or if somebody has to evaluate an option to invest in an Indian company, and if an Indian company has taken a valuation report from a valuation profession in India, and if he passes on this report to the outside consultant or an investor who is situated in a different country, now he has to read this report and understand in what sense the Indian professional has been prepared this. So this enables the global perspectives on the topic in order to get a readability. So that has consistent valuation policies. All of this has achieved, or the valuation standards objective is to achieve these things. I do not tell everything is achieved 100%, but since valuation standards have been implemented in India since 2018, it has greatly made significant changes in these areas by achieving at least certain amount of progress in these in all of these parameters. All of you are with me? Yes?
Yes.
So making some sense?
Yes.
I am not sleepy. Are you? Okay. So, like I said, the valuation standards in India was issued by ICA. There was a valuation standard. There is a specific board which is formulated or formed by the Institute of Chartered Accountants of India. The need to have the consistent, uniform and transparent valuation policies and harmonize the diverse practices in India. So since we had no set guidelines, it was diversified. So in order to get a common platform to all these kinds of procedures, the objective was to form a specific valuation board, a standards board in 2017. And this board came up with the standards, framing the valuation standards in terms of the valuation profession, regulating the valuation assignments in India. So if you see the functions of the valuation standard board, it looks at the formulate valuation standards so that such standards can be adopted by registered valuers organizations in India, the government and other regulatory bodies. So we'll see what is a registered valuers organization. So there is a specific institute which is regulating the valuation profession today. It's not Institute of Chartered Accountants of India, but it is a different institute. We'll see that hierarchy and what role does RVO plays, that is Registered Valuers Organization. We'll see that. The Valuation Standards Board will provide interpretations and guidance on issues arising from valuation standards. So a lot of literature has been there, a lot of background has been there, and the institute has doing very good work in terms of the valuation series. There are valuation related practical scenarios getting covered in compliance with the valuation standards issue. So if you see the valuation insight, there is a publication which is issued by the ICAI, which valuation insights, series 1, series 2, and it has gone till series 7. So there is a good amount of research work that is already being performed by the valuation standards board and the committee, and there is a good amount of work which gives the guidance along with the valuation standards that is already prescribed by the board. And also the valuation standards board will also review the valuation standards at periodical intervals and if necessary revise the same. So this is the main functions of the valuation standards board. Moving further, like I said, the monitoring bodies, so it's the Insolvency and Bankruptcy Board of India which regulates the profession in India. So when we see the history, or when we see, go back in time for a moment, certain years back before this regulatory body came into picture, most of the impact that they felt the need for a monitoring body is because of the valuation of physical assets. So when the valuation of physical assets, how do we take care of valuation of physical assets? So what will be the need? So whenever there is a requirement for a funding, so the company or the business person will go to the banker and tell that I have a physical asset, land or building or something. So they say you can hypothecate or mortgage this land and give loan against this physical asset. So when they take this, how do they assess how much loan that they can give is based on the value of the physical asset that they are mortgaging. When they have to evaluate this, they will send a bank empaneled valuer to review the value of the land or the building that is going to be mortgaged, and they submit the report to the banker, and the banker will fund that much eligible fund. And later, after few months or few years, when the borrower is not able to clear the dues and he goes bankrupt, then the bank will go and has to discharge the mortgaged asset, and it has to realize by selling the mortgaged land. And when they go for real market sale, they realize that the value is very less as compared to the valuation report that was submitted. So this was the need that they felt, that there is a lot of variations that are happening in terms of the valuations that are being done in the India in terms of the banking terms. Initially it was in terms of the physical assets, but later on it became the financial assets also. In terms of the financial securities also got valued and became the part of mortgaging funding facility, which was valued lesser or more. In order to regulate that, then they formed a body which was already there in terms of the Insolvency and Bankruptcy of India. They have given this in charge of monitoring the valuations to the IBBI. So there is also the draft bill, which is telling that there will be a separate entity which will monitor the valuation professionals. Then it will move on from IBBI to the separate institute on a full-time basis. So under the banner of the IBBI, there are registered valuers organization who will monitor the registered valuers and who will also ensure this valuation standards are being applied. So currently, just to quickly have a run through, there are 16 RVOs, out of which 15 are active, and some of the RVOs are listed just for having an idea as to what are the registered valuers organizations are there. So now having understood the hierarchy or the monitoring bodies, how the valuation standards or valuation profession is being monitored, let's get into the further aspects of the end uses of valuation standards. So definitely if there is something that has to see what is it meant for. So when we see the purpose or the need of how it is going to be benefiting at the end, it is the three different categories that we have seen on the screen here. That is, one is financial reporting, the strategic decision making. The third one will be the regulatory requirements. So these are the broad framework or the broad end use cases in terms of the valuation standards. So when we see the financial reporting case, already we have, so this is now familiar for all of us because since morning we have already seen these kind of terminologies and reference to these kind of Indian accounting standards, isn't it? Do you recollect, or how is it? Have you seen these topics in the morning?
Yes.
Business combinations, ESOP accounting, goodwill acquisitions, yes or no?
Yes.
So it's now kind of a revision or a testing kind of thing. Anyways, So when we look at the share valuation for goodwill and asset impairment testing, so this requires on every reporting date, one is at the time of acquisition, goodwill has to be valued, and also at the every reporting date it has to undergo an impairment testing as per Ind AS 36, and accordingly the valuation standards will be required to be applied here. Then comes the ESOP valuation under Ind AS 102, which at the time of grant, at the time of exercise, at the time of different vesting periods. So this all gets into complication because they say every grant date. Now, if let's take an example in terms of every month there are 5 employees joining. So over a period of 12 months, 60 employees join, and every month there is employees who have joined. And the policy of such that organization is such that whoever joins, they're giving options, employee stock options. So when every month stock options are given, so the grant period, the vesting period, the exercise period starts from every different month and ends on a different month for each of the employees who have joined in those respective months. Correct? So the valuation standards come into picture here in order to see how the valuation has to be done in these kind of complex situations, whether you will have to do it for every vesting, or can you group it as a quarterly basis valuation, or it can be done yearly once. So these are the complexities which get ironed out when you see the standard procedures and standard principles outlined in the valuation standards. Then comes the intangible asset valuations for business combinations under Ind AS 103, which we have seen dealt in the second session in terms of the purchase price allocation in length and detail for the accounting purposes. So all of this is mostly in terms of the accounting requirement, in terms of the financial reporting or preparation of the financial statements, disclosures. Now moving to the strategic decision making. So when we see strategic decision, so there are two types of requirement. One is regulatory and the advisory. So this strategic decision comes under the advisory requirement of valuation. When the transaction is still not being concluded, where the companies or the investors or the company is looking for funding, and what value at which they should approach the investor, or at what percentage they should go for dilution. Now all of this comes under the strategic decisions in terms of it can be the acquisitions or the mergers, or in terms of the business combination. Any of that matter will get structured in terms of the advisory decisions. And also the second part of it is in terms of the legal decision making. How does it legally impact? And if there is any dispute, how the dispute can be resolved by way of a valuation. So there are situations where courts have asked for valuations where the directors get into conflict, and who should have the control on the asset and who is going to exit. So in these situations, the courts ask for the valuation report in terms of at what value one person can get the exit and the other person can take over from the other shareholder. So these are all the examples of the scenarios where the disputes can happen. In terms of the minority shareholding also is another example. And then comes the joint venture kind of situations, or any kind of situations of fund mobilization or any private placements. For all of these situations, we will look at the strategic decision making purpose. The third and the last usage of the valuation standards is the regulatory requirement, which we have already seen in the third session, isn't it? So Companies Act, Income Tax Act, and in terms of IBC, income, and the FEMA requirement, SEBI requirement, all of those is here. I am not going to repeat again. Now that we have understood a framework behind the scene of valuation standard, yes or no? Have you got the fair idea as to why valuation standard is required? What was the reason of a formulating body coming into picture and the regulatory authority? And after having understood all this, there was a specific board being formulated, and they have gone into issuance of the valuation standards. So that is where we see the Indian valuation standards are issued by the Institute of Chartered Accountants of India in June 2018, and this valuation standards is being adopted by the RVO. So basically RVO has to follow or adopt one of the valuation standards so that the members of such RVO will follow that valuation standards. So in this case, the ICAI RVO has adopted the ICAI issued valuation standards, thereby the members or the registered valuers of ICAI RVO will be definitely required to follow the valuation standards issued by ICAI RVO. In that case, what does it happens in the other RVOs? The other RVOs also has an option to adopt the valuation standards from ICAI, or they have option to adopt any international valuation standards, and that will be the standard which the members of such RVOs need to follow and comply. So quick outline of what are the standards that are being issued by ICAI. So we have ICAI valuation standard 101, which talks about the definitions. So this is the indirization that I can tell, because in international valuation standard there is no separate standard for definitions. Why are we seeing a specific standard for definitions in India? Now if you refer any law that which is in effect in India, if you see the first section is the title and the second section gives all the definitions in one place, isn't it? Similarly here they ensured that all the definitions that one valuer has to read in terms of other valuation standards are enlisted in ICAI VS 101, which is definitions completely. Then comes ICAI valuation standard 102, the valuation basis. Then 103, the valuation approaches and methods. We will see the brief contents of each of the standard a little later. So just to run through the taglines. 201 talks about the scope of work, analysis and evaluation. 202 talks about reporting and documentation, how a report needs to be drafted and how the documentation should be taken care of in terms of the valuation assignment. 301 talks about the business valuation. 302 talks about intangible assets, and 303 talks about the financial instruments. So this is the pretty much very simple. We don't have like accounting standard 30, 40, 30 kind of 20 to 30 kind of standards. We have pretty much simple standards here, less number of standards. In the international scenario, what we call as international valuation standards, which is IVS, serve as the key guide for valuation professionals globally. And their objectives is also consistency, transparency, and create the confidence in the work performed by the valuation professionals across the world. So this is the international scenario, also the same kind of objectives that are there. Now when we see international scenario, we have different organizations which are issuing the valuation standards. Now what are the different organizations? The first and foremost and very popular and commonly known as the International Valuation Standards Committee, which is Council. So this is the IVSC, is one of the most popular organization which has been more active in the field of valuation standards. Apart from that, there is the Appraisal Foundation, the Royal Institute of Chartered Surveyors, the CFA Institute, the American Society of Appraisers, and the Canadian Institute of Chartered Business Valuators. Now these are the different international organizations which are issuing valuation standards of their own. Okay. Now the different countries become members of these organizations and they subscribe for this compliance in terms of the valuation standards. And ICAI is one of the member of International Valuation Council. And that is how the ICAI is contributing to the International Valuation Standards framework and procedures. Now what does IVSC say? IVSC say any country or any member who is any member of the IVSC, they can draw reference from the international valuation standards and they can create their region specific valuation standards. But however, when we see the ICAI valuation standards, they have not drawn reference from the IVS and they have not taken reference from there and created it, but they have worked upon afresh. Okay, they worked upon afresh and they have issued the fresh standards. So first, when we see the evolving of this IVSC, it is first for the real estate valuations. It was established in 1981, but then the first time the Valuation Standards Committee was formed in 1985 internationally. The latest version of International Valuation Standards, effective as of now, is 31st January 2022. So usually every year there is a changes that they review and make changes into the valuation standards internationally. So 2023 and 2024 they had 2023 they had some recommendations which were supposed to be implemented in November 2023. They had publication which was made, and it was made effective in 2024, but the notification came into picture, but they made that effective from 1st January 2025. So as of today, what is prevailing is what is issued as on 31st January 2022. What is notified for January 24 will be effective from 1st January 2025. So like I said, international valuation standards issued by Board of IBAC, which works as guidelines for member organizations to issue regional or country specific valuation standards. So however, it is important to note that ICAI valuation standards have not drawn reference from IBS, but they have drafted everything afresh with a lot of research and effort. In that way, we'll have to appreciate and we'll have to be pride that ICAI has done this contribution to the valuation profession. So in terms of the valuation standards internationally, IVS, like Indian standards, we had the numbers that we saw. If you see internationally, there are two classifications. One is general standards and the asset specific standards. On the left hand side, what you see is the general standards, and on the right hand side, what you see is the internationally issued asset specific standards. So IVS 101, that is International Valuation Standard 101, talks about the scope of work. 102 talks about investigation and compliance. 103 talks about reporting and the basis of value. 105 talks about valuation approaches and methods. So this is general. So that means it applies across to all types of valuation, irrespective of the asset that you are valuing. But when it comes to the asset specific, you have IVS 200, business and business interest, that is the popularly thing, that is the asset approach, the market approach, the income approach, all the major valuations of business interest, financial assets are getting covered under 200. 210 comes with specific area of focus, that is intangible assets. 220 comes with non-financial liabilities. So what could be the examples of non-financial liabilities? We'll go in, we'll refer it a little later, but just for the sake of taking some inputs now, any idea as to what could be non-financial liabilities?
Provision for warranty.
Yes, provision for warranty. Any other example? Contract liabilities, so that is the contingent liability kind of thing. So all of this comes under the non-financial liabilities. So how to value a non-financial liability? So there is a guideline at the international level which is there at IBS 220. IBS 230 inventory, IBS 300 plant and equipment. So there are specific asset based, inventory is a specific asset, plant and equipment is a specific thing. 400 real property interest, 410 development property, 500 financial instruments. So this is the list of the international valuation standards. So did you get a fair idea as to IVS and the Indian valuation standards? Until now, any questions and anything that is not clear, or you need more inputs on any of the aspects that we have discussed till now? If I could take any of those related, I can pause a moment and take those questions and then proceed. Nothing? All well? All well or all sleeping? Okay, fine. So broadly, one more aspect to get into understanding is the different asset classes that are there: the land and building, securities and financial assets, and the plant and machinery. So we have three broad classes which are notified by the valuation profession in India. So today's discussion will predominantly be more focused about the securities and financial assets valuers. So if you see valuers will be under these three categories. A valuer can be a land and building valuer, a valuer can be a SFA valuer, a valuer can be a plant and machinery valuer. So it is a three sub-segments under the valuation profession. So, yeah.
I have one question about the inventories.
Yes.
So in real estate companies, the projects which are developed are generally under the inventory. So a land and building valuer will have to take that on. So
Correct.
will we include that in SFA report or like exclude?
So Here, the inventory is a grey area. It is a part of the plant and machinery value or a land building. In case of a real estate, it clearly falls to the land and building because the asset underlying as inventory is the land and building. So it comes to the purview of the land and building valuer, in my view. So the land and building valuer has to valuate. The valuation given by the land and building valuer has to be relied upon by the SFA valuer in his business valuation report.
So SFA valuer only will have to take that value and include in this.
Correct. SFA valuer has to rely on another expert, that is the land and building valuer. So he cannot directly assess the land and building value in his SFA valuer capacity, but he has to rely upon a land and building valuer who performs it in terms of the specifications of the land and building valuation principles, and he issues the report. That report will be relied by the SFA valuer, and that value of land and building will be incorporated in the business valuation as per his valuation opinion. So then we have plant and machinery, SFA and land and building. So these three are segregated in terms of the accreditation also, or any person who wants to become a valuer also, he has to undergo a different set of program in terms of getting that acquaintance. So there are three different categories of exams, and whoever qualifies that will become the registered valuer of that particular asset class. So now let's we go into the actual crux of the valuation standards in order to see overview. I am not getting into too detailed technical aspect, but I am going to give you an overview as to what the valuation standard talk about, what does it achieve, and then we'll quickly move to comparison of the international scenario versus the Indian valuation standards. So with that, we will be concluding the session, but this is what is there in the store till we conclude this session. Yes, are you all ready to take this ride? Are you all ready to take the ride of valuation standards with me now? The valuation standards is now starting till now. If you have not heard till now, it's okay, fine, no problem. If you listen for next 15-20 minutes, you will get the valuation standards. So you have the option to be alert now. Yes? So everything is starting as zero, fresh now. Happy afternoon everybody. Let's start the session of valuation standards now. Yes? Okay, fine. So ICAI valuation standard definitions 101. Like I said, there is no corresponding reference in IVS. So IVS gives the definitions in the respective standards, but does not give definitions in one place. So there is a separate standard in ICAI valuation standard. So this standard focuses on explaining the various terms used in the valuations. And then we have 102 valuation basis, that is the ICAI valuation standard. Corresponding valuation standard equivalent internationally is IDS 104. So what is this basis of value? So any valuation, before we start, what is the premise? So that we call it as a premise of the value. So whether it is on the acquisition mode or whether it is on the liquidation mode. If it is on a liquidation basis, then we'll have to take the liquidation value. If it is on an acquisition or if it is on a growth perspective, and we will look at the value in terms of the fair value or the fair valuation perspective. And the acquisition, whether it is a control based acquisition or whether it is a normal acquisition. If it is a control based acquisition, the procedure is different. Okay, so the base of the valuation will describe the nature of the valuation based on the subject asset to assist in identifying the method or approach of the valuation. What method has to be approached or what method has to be adopted in terms of doing the valuation process. 103 gives the valuation approaches and methods. The corresponding IDS, International Valuation Standard, is 105, which gives the valuation methods issued by the different international organizations and the ICAI also, that is the ICAI RVO which is adopted. So we will go in detail in the subsequent slide what are the different valuation approaches. 201 talk about scope of work, analysis and evaluation. Corresponding international valuation standard is 101. So what does this scope of work, analysis and evaluation? So analysis and evaluation of the part which is there in ICAI valuation standard is not there in the international valuation standard. International valuation standard merely says scope of work. But in terms of the Indian valuation standard, the ICAI has told that you have to have how an analysis and evaluation has to be done. Also it is prescribed in terms of 201. But if we see the same reference, that part of equivalent analysis and evaluation is taken care in 103, investigations and compliance. So the word investigation, which we mean to understand in the Indian context, means that there is something wrong. Something mishappening has happened, thereby the investigation is happening, the fraud activity, or is there some mishappening. So the Valuation Standards Board thought it soundly and felt that using the same kind of word of investigation will not suit the Indian context, and they said analysis and evaluation in place of investigation. So it is nothing but analysis of the valuation and the interpretation, which is covered in 103. So 201 reporting is equivalent to 101 of reporting, but however the scope of work of 201 is equivalent to 101 of scope of work, but the analysis and evaluation is covered in 103 in international valuation standards. So now getting into the scope of work. So we'll have to understand as to what is the scope of the asset that needs to be valued. Correct. So in the second session, Chinmay was giving a beautiful example as to how the conversation between the client and the valuer happens. That defines the scope of work. What is that we are going to? That is more of kind of a discussion which was tailored for a purchase price allocation discussion, but similar kind of discussion should happen between the profession and the person who is receiving the valuation report from the valuer. So then the outline of the assignment will be very clear, and what is the coverage and what is the subject asset to be valued will be defined in the engagement letter. Then comes the reporting and documentation. 202 talks about the reporting and documentation. On the counter side, 103 talks about the reporting and investigation and compliance along with the reporting. Until now, there is no documentation here. If you see the difference here, ICA valuation standard and IBS, there is no documentation in the international valuation standard. The recommendations or the guidelines that they have given in 2023, now that they realize that they won't have to bring documentation into it, they have now included reporting, documentation, investigation and compliance, which will be effective from 1st January 2025. Okay? But as of now, it is only reporting, investigation and compliance. So now, when we see from this perspective, ICA valuation standards are now becoming guideline to draw reference and make changes in the international valuation standards. Okay? So we will see such kind of one or two more aspects in the future slides, where we see that some of the best practices which are not prevailing with the international valuation standards have been plugged in the Indian valuation standards. So then we have 301 business valuation and 200 the business and business interest. Slight variations in the terminologies, but however predominantly it is the same kind of coverage, both the things that we have. So this standard puts light on the asset under valuation, and that it should be valued in line with the purpose of the valuation. So what is the purpose? Based on the basis of valuation, the premise that we derive, in compliance with the premise or the base of the valuation, we'll have to comply the entire methodology of the valuation or the approach of the valuation. This standard states specific requirements for valuing the business and business interest. Like what approach needs to be considered for in insolvency proceedings company or CIRP proceedings company, or what approach you have to take in terms of a startup company, or what approach you can take in terms of the highly mature company or a very early stage company. So these are the guidelines that we can take from these standards. And 303 financial instruments, 500 financial instruments, counterpart of IBS and ICA ABS, which talks about the modifications and additional requirements in terms of the valuation of this specific standard. There, in terms of financial instruments, when we talk about, I think we have in Ind-AS also, the what are the financial instruments. So similar kind of guidelines. But fair value when we take, we'll have to draw references from these things. Until here, we have side by side. Okay, that is both ICA ABS and IBS. But from here on, it is all only the IBS. There is no corresponding ICA valuation standards. So in these cases, we'll have to rely definitely back to the international valuation standards, that is non-financial liabilities. So if we see here, like we discussed some time back, what is a non-financial liability? It can be provision for warranties or contract liabilities or environmental liabilities, asset retirement obligations, certain contingent considerations. Guidelines to value these non-financial liabilities are given in IBS 220. Okay. The last set of valuation standards, that is IBS 230 inventory. So earlier there was no specific valuation standard in terms of the inventory valuation. it had come in the recently, and this gives the direction how our inventory valuation has to be done. In an Indian context perspective, the three different asset classes that we have, like we had discussion sometime back, who has to value the inventory? So for plant and machinery, there is a plant and machinery value. For land and building, there is a land and building value. For the business asset, there is a securities and financial asset value. So inventory, will it form part of SFA or will it form part of the plant and machinery? So it is a grey area. Even today, there is no clarity and there is no guidance as to who has to value the inventory. Most of the practical situations and scenarios, it looks like if it is the inventory is in the form of real estate, land and building, the land and building valuer will take up and completes the valuation. And if it is any other regular plant and machinery related inventory, the plant and machinery valuer will do it. And the balancing part where both do not take up, then the SFA valuer has to take himself the position to take the value. Then we have 300 for plant and machinery. So how does the useful life of the asset look like? What are the economic factors? What are the benefits that the plant and machinery will derive? All of this will look like the given as guidance in the 300 plant and machinery. Then comes the 400 real property interest. So this standard deals with the right of ownership, control, use or occupation of land and building, like the real estate joint development agreements, the right to use the property, the leased lands, all of this comes under this specific standard, the IBS 400 property and interest. 410 development property, where the property is under development or to be developed in future. So those kind of properties comes under 410, are defined as interest where redevelopment is required to achieve the highest and best use. So basically the current position of the property, it is not in the form that it can be used for its best use. If it has to fetch a best use, then it has to be redeveloped. Let's say there is an old building in the center of the city, MG Road, which is not fetching a proper rentals. If it is demolished and reconstructed, and if there is a new mall that comes in, there is a lot of value that it can fetch. So it is called as redevelop the property and then ensure that there is an highest and best use from such kind of property. So those kind of assets gets covered under IBS 410. So here we come to the end of all the standards in terms of the brief of each of the standard as to what it is intended for and what is the coverage and what is the guidelines that is being given. So now this gives us the clear indication as to see in each of these respective valuation scenarios, there is a guideline. So how we'll have to fall back. So if we have any roadblocks or any kind of challenges, definitely we get guidances from these valuation standards in those respective asset classes or the standards in order to get the right direction to clear those roadblocks and challenges. So quickly we'll move to the last segment, last but one, the valuation approaches and methodologies. So now this is more familiar. Is it viewable? Are you able to see?
Yes.
Yes, or you want me to zoom? So what we have is the valuation approaches. What we say is ICAI valuation standard 103 talks about the valuation approaches and methods, and then we have on the counter side IBS 105 valuation approaches and methods. So when we see this, there are the market approach, which is talking about the market price method and the comparable companies multiple and comparable transaction multiple. So these are the three methodologies that is being given under the market approach under ICAI. In terms of international valuation standard, we have comparable transaction method and guideline publicly traded comparable method. So when you see side by side, the market price method is not there in the international valuation standard. You have only comparable transaction method and generally guidelines publicly traded company. Now when you come to income approach, on the international scenario, you have only discounted cash flow method as the recognized method of valuation under the income approach. But when it comes to the Indian valuation standard, we have 5 different methodologies that is being prescribed. Not only discounted cash flow method, but it also talks about relief from royalty method, which we saw in the purchase price allocation, how to value intangibles, correct? So relief from royalty is a derived methodology from the income approach. multi-period excess earning method, with and without method, and option pricing models. All of these are given in the income approach methodologies. Then comes the cost approach methods, where we have replacement cost method and reproduction cost method. So these are the two different approaches. The cost approach talks about what is the cost required to reproduce the entire business or the entire asset. So that is the value that is being considered as the approach. Or if not for recreation, if it has to be replaced, what will be the cost? So that is the kind of methodology that they will be taking here. Under international scenario, we have replacement cost method, reproduction cost method, and summation method. So summation method is something like you take 2-3 segments of the company. Instead of valuing the entire business as a whole, you value the segment of the company separately at the cost level, and then take the summation of all the 3 segments. Then you get the summation method. So just to give you a quick example of replacement method or a reproduction cost method, let's say that there is some kind of an existing business. So some, let's say, a lab technician or a lab diagnostic center. Now this lab person or the doctor who is doing a diagnosis is running independently the diagnostic center. So what does he do? He usually does the scanning reports or the MRIs and all of that, and he reads that and he advises that. So that is his business. Okay. Now there is a big chain of diagnostic center. Apollo will approach him that why don't you sell your diagnostic center to me? So now how do we value this diagnostic center? One of the best approach that we can take is the replacement cost method for this kind of transaction. So what is the cost that Apollo will incur if they have to set up a similar kind of diagnostic center? So the diagnostic equipment has to be bought in. What is the cost of the diagnostic equipment in terms of the fixed capex? And the infrastructure has to be put up. What is the cost of infrastructure? And the maintenance has to be done by way of, along with the main doctor who is the diagnosing person, there will be some supporting medical staff. So 2 to 3 staff will be there. What is the cost of those people? And what are the consumables? So all of this you take the cost and then you add the profit to it. So let's say the profit element, the developer's profit we call, and then that profit element and this kind of costing will become the value of that diagnostic center for a transaction of acquiring the entire business as a whole. So you're getting an idea as to how this approach or the different methodologies can be used in terms of the valuation approaches. So let me pause here for a moment if there's any questions on this approach.
So summation method. You said you will value each segment separately in the market. Segment, how will you value?
So let's say a particular business is having a hardware business and also a software business. So hardware business will have the business factors, the economic factors or the business growth factors different as compared to the hardware. So the assumptions I will take specific to the software sector separately and do the valuation, and hardware sector separately and do the valuation. Then whatever the value comes, the both value will be added and that value will become the entire enterprise value. Where am I being different here? Instead of giving common assumption to the entire business as a whole, I am becoming more specific to each of the segment of the business.
But each
approach will be the same.
Whenever you are valuing the software business or hardware business, you will use one of the other approaches like a market approach or income.
Correct.
So it's basically extension of the previous other two approaches.
So now we quickly, okay, any other questions or any other points to discuss or add?
Sir, RV registered value will be bound by if he is member of the ICI RVO, then he will be bound by the ICI valuation.
That's correct.
So in that case, does he have the liberty to choose for any options from the IVS, for example, the summation method?
So that is the basic thing. He can apply for additional methods. So he should comply with the ICA valuation standard. That does not mean he will comply only these approaches. So any chartered accountant or any member of ICA RVO has to follow the ICA valuation standards. Basic minimum requirement. Can we proceed? So the last segment for the day that we have is the comparative of valuation standards. So the scope of work valuation standard. In Indian valuation standards says that it should be mandatorily in writing. Okay, mandatorily in writing. But when it comes to international valuation standard, there is no specific thing they say that it should be in writing. They say there should be a scope of work, there should be an engagement terms. Whether it is in writing or oral, they are not having any specific guideline to impose. But in case of Indian valuation standards, they say specifically that it should be in writing. So this is where I said we see the best practices being adopted by Indian valuation standards as compared to the IVS, whereas IVS is international scenario, it is being more liberal, but it is becoming more cautious and more specific in terms of the Indian valuation standards. Moving to the second difference, we have change in the scope of work. So ICA valuation standard deals with this kind of situation, and it says that any change of scope of work must be in writing. Again, the scope of work should be writing first instance. If there is any change, it should be again in writing. It cannot just become an added discussion over the call. In terms of international valuation standard, they say it is not required to be in writing. Now, any scope limitation, unable to perform. So ICA valuation standards say that if the valuer is unable to agree to any terms of the engagement and is not permitted to continue as per the original terms, he may withdraw from an engagement and need not report it to the client. So specifically they have carved out telling that if the valuer is having any limitation on the assignment in terms of information being given, he is unable to perform. If there is any undue stress, he can withdraw from the engagement without even informing the client. So that is the kind of liberty that they give. But when it comes to international valuation standard, nothing is mentioned regarding the disagreements to the change terms of the engagement. So that has to be mutually agreed between the valuer and the subject company. And when it comes to the currency, in terms of the Indian valuation standards, it does not specifically mention the currency of the value derived. Okay. But when it comes to the international valuation standard, they make it more specific to state that the currency in which the value is being reported has to be mentioned, whether it is USD, whether it is GBP, INR, USD, CAD, whatever it is. So why does this become more significant at international level? Because it is applicable to the global framework as a whole. Different countries, different regions. Let's say you are valuing a group of companies which has presence in 40 different countries. So there will be 40 different currencies in most likely cases. So if you just give value, it does not make sense whether it is USD or whether it is which currency. It does not make sense. So then it becomes more relevant to give the currency. So mentioning of valuation currency is mandatory as per international valuation standards. And then comes the fees part. ICA valuation standard says that fees for valuation is mandatory element to be mentioned in the engagement letter. So when an engagement letter, now this is the kind of clarity and the common practices, the principles that they have brought in. There should be an engagement letter. That engagement letter should contain the scope of work. And the scope of work, if there is any change, it should be documented. And when the fees agreed between the parties has to be mentioned. And they also give the clear indication like how the Chartered Accountant Code of Ethics gives that it cannot be valid the percentage basis, contingent of the activity. So it should be fixed fee irrespective of the kind of effort. And then in terms of the international valuation standard, there is no mandatory element that the fees should be mentioned in the engagement letter. First of all, there is no engagement letter mandatory to be in written. So even if it is there, there is no mandatory of fees to be mentioned. So limitations and investigations or analysis. So no limitation on the valuer for investigation by the valuer. So he can get into any kind of analysis, any kind of documentation, investigation, and he can do it. So ICA valuation standards gives that liberty. International valuation standards say that limits may be agreed. So this is the kind of limitation that the valuer has. You will have to perform the valuation within this framework. So that is the kind of the imposition that the international valuation standards have. If limitations on the investigations are substantial, that the valuer cannot evaluate the inputs and assumptions, the valuation engagement must not state that it has been performed in compliance with IVS. So IVS says that you can have the limitation, but if the valuer feels that it is inherent limitation for him to complete the entire evaluation, then he will have to state in his report stating that he has not done the valuation in accordance with the IVS. Okay, so that is the kind of guidance that they give. In terms of the subsequent event, so when we see the valuation as an assignment as a whole, there will be something called as relevant date and the valuation report date. So the relevant date is nothing but the valuation date, right? On a particular date when the valuation is being performed. So that is the valuation date, and from that date, if the report date, if there is any subsequent changes or any impacting events, that needs to be considered in the ICAI valuation standards. But that subsequent events are not of relevance in the international valuation standards. Then the management representation letter. So a valuer may obtain written representation from management regarding information for performing the valuation assignment. So this is again more of like audit prescription that we have management representation letter, but similar kind is not there in the ICAI international valuation standards. So these are more of like, looks like that more comprehensive and more kind of precaution based guidelines that are given in the ICAI valuation standards. The last difference factor, the reporting. Reporting is being specific format is being prescribed, like in the earlier session where the lot of emphasis was drawn, telling that IVS has given, valuation standard has given a specific format which has made life simple of valuers in order to give the valuation specific elements of valuation report. That is this, telling that there are 13 elements which are prescribed by ICAI valuation standards which needs to be mandatorily forming part of any valuation report. In terms of international valuation standard, they say 8 elements. So it is not that it is lesser in terms. When you compare line by line, you see that 2-3 points are getting merged in one element. So more or less both are same. So they're ensured that the main important aspects are forming part of the report. And when it comes to documentation, all documentations that are being considered in the valuation assignment has to be maintained for a period of 8 years in terms of the ICAI valuation standards. When it comes to international valuation standard, they are not specific about the period for which a valuer should retain the valuation documentation, but in Indian ICAI valuation standards, they are more specific to state that for 8-year period, the valuation profession should maintain the supporting documents, evidence, everything being collected and performed in the valuation report. So they can tell what are the things. I'll quickly enlist all of those, and they say indicatively minimum 8 documents to be maintained by the valuer, and there is no specific list in the valuation in the international valuation standard. But the November 2023 guidance that they are given, which is effective from 1st January 2025, international valuation standard is also bringing guidance on documentation that will contain certain guidance on the documentation. So these are the 13 reporting requirements. Just you can have a quick glance. It is talking about background information of the asset being valued, purpose of the valuation, who is the appointing authority, restrictions of the usage of the report, disclosure of the valuer conflict and interest. Okay, so major factors that were taken into account during the valuation, nature and source of the information used and relied upon. Okay, so these are the basic things that should be there. What is the valuation methodology being used? What are the limitations, disclosures, disclaimers? That is a separate mandatory content that should be there. Date of appointment, what is the valuation date, what is the valuation report date? 3 different dates should be forming part of the valuation report. Procedures adopted and what is the conclusion. So I cannot do everything and leave it without concluding. I should have a specific segment where I conclude my entire valuation report in terms of my writing of the report. So these are the 13 reporting requirements which are mandated in terms of minimum requirement. Over than this, more than this, there can be any other parameter, but at least these 13 parameters has to be taken care. So whenever you come across any assignment of valuer or valuation report, you can look forward this and see these are the minimum requirements in the as per valuation standards. Then comes the documentation requirements. Like I said, 8 elements. These are the 8 documents which needs to be maintained for 8 years. Okay, as per the valuation standards. It says that engagement letter, appointment letter, one category. The basis of approach methods, combination thereof used to arrive at the value. So there will be a lot of working papers that are there, which will not form part of the report. So that basis, that back-end workings should be documented. Copies of relevant circulars, extracts of legal provisions, tabulation of data obtained during the course of valuation. We rely on many third-party data, third-party resources, external data. All of that needs to be documented. Assumptions, change in which may materially affect the value. A copy of the signed valuation report. So they also very clearly mentioned that whatever report you have issued, you also have a copy with you for the next 8 years. I cannot tell I will sign one copy and give it to the subject company, and then tomorrow if somebody comes and check, I do not have a copy. So I cannot tell that I should have the second copy with me. Management or client representation letter, workings undertaken to arrive the value. So these are the indicative documents which has to be documented for the next 8 years as per the Indian valuation standards, which is now also included as a guidance in the international valuation standards from 1st January 2005. So I think with that I have done my part of it, and any questions for me and any points to discuss, we can have it now. Okay, thank you all. I think with that we can close for the session. Thank you for patient listening, and thanks the Bangalore branch of CA for giving me an opportunity to share my thoughts on the valuation standards, and the Bangalore branch for giving me an opportunity to be here. Thank you.
Thank you, Kuashik. We will just break for a tea as of now and reassemble for the panel discussions. Later on, we'll have the Thank you.